Hello and welcome. In this month's on-demand webinar, OJM Director of Financial Planning, Michael Lewellen, CFP, discusses the importance of long-term care planning for those wanting to protect assets for a spouse and other family members. Michael compares traditional and alternative types of long-term care insurance, presents financial examples, and outlines the pros and cons of each option. It's important to note that this webinar is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books, including our newest book, Wealth Management Made Simple. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Thank you for joining us. Today we're going to discuss long-term care insurance and ways to make sure that you can protect your wealth. First, we're going to look at traditional long-term care insurance. Then we'll break down asset-based long-term care insurance. And then finally, life insurance with a long-term care accelerator or rider. We're going to look at the positives and the negatives of each of these options and which to try to determine which may be best for you. Traditional long-term care insurance, the positives are that it's the lowest out-of-pocket expense. So think of it more as like if you have a disability insurance policy, it's much like that. So out of the gate, you are paying premiums that are on the lower end. You are fully underwritten, so you may qualify for preferred rates. The advantage there, obviously, being that if you are healthy, you can have a lower premium. There's the potential for a tax deduction. It can be deducted if your medical expenses exceed 10% of your AGI. It can be included in that. Some of the negatives, nothing is guaranteed. So you may be familiar with some of the negative press that traditional long-term care has been receiving. A lot of carriers have pulled out of the marketplace altogether. And the reason for that is the pricing of the product in the early 80s was just way off. And then on top of that, the low interest rate environment or the extended low interest rate environment has really prevented carriers from being able to support the products that they put in place. So that is something, when you're looking at it from a price standpoint, the prices have definitely gone up. There really aren't any quality carriers that can be there. And nothing is guaranteed. So your premiums can increase. So even some of those policies that were written in the early 80s, they've seen increases in premiums that have taken place. But at the end of the day, again, it is one of the least expensive options, and in certain environments could be right for you. Let's look at an example here of a 55-year-old at preferred class, so not the best and not the worst. The premiums are $3,730 a year. So you pay those premiums just like you pay your disability insurance. Your death benefit is nothing. If you were to pass away, it's a use it or lose it. So there's no death benefit. There's no return of premium generally in products like this. The way that it's set up, when you initially, right out of the gate, your death benefit pool, your long-term care pool is $250,000. So if you purchase the policy on day one and on day two went on long-term care claim, then you would have a pool of $250,000 that you would be able to pull from. The max monthly benefit, though, that's important. In this example, is $3,500. So you would be able to use $3,500 to use towards long-term care benefit. Now, you can see there's an inflation rider on this example here. So your long-term care pool grows. In this example, at age 85, it's over $1 million. And then you are able to use $14,406 of monthly benefit in that scenario. So one of the advantages, obviously, is that it keeps pace with inflation from that standpoint. So if you look at the gray line there, you see that the gray line is an increasing number. If you look at the blue line, which is the premium, you can see the premiums generally start and then can go up or going to trend to go up. And then the monthly benefit, obviously, is, at the number. It currently starts at that number, but can go up over time as well too, as we discussed. Asset-based long-term care. This is one that's become much more popular over the last 10 years. If you've ever heard of a product called MoneyGuard, which is really the most popular in this space, that's what this is. This is actually a life insurance contract, but it is primarily long-term care driven. So some of the positives, it has very strong guarantees. Once you purchase this contract, you know what your benefits are going to be 20 years from now, 5 years from now, right out of the gate. So it has very strong guarantees in place. So you know what you're getting when you purchase this contract. Many offer a return of premium. So whatever you put in, an example we'll look at, it shows about $100,000 going in. At any point, if you wanted to get out of it, you could say, hey, I want to surrender the contract, and you could get all of your money back. It also has large long-term care benefit pools. There's an inflation aspect to it that we generally see, and their underwriting is simplified, so it's much easier to apply for that. It's more of a phone conversation and application. The negatives, one of the advantages is obviously there's a return of premium. One of the negatives is essentially that's what your death benefit is. So if you were to pass away at any time and you put in, again, we'll look at an example here in a few slides, where you put in $100,000. If you were to pass away, that's what your death benefit is going to be. And there's no preferred rating available. So it's either you're approved or you're not approved type of contract. So let's look at an example here. So you can see you put in $20,000 for 5 years. Now, how you fund is flexible. You can do one time. Sometimes people do a one-time premium payment. You can do 5 years here in our example, or you can do 10 to 20 years. The advantage of a shorter premium schedule is your benefit is higher initially and grows from that standpoint. So if you look at the death benefit here is a little over $100,000. So if you were to pass away, you're getting a little bit more than you put in. The initial long-term care pool is more than triple of what you're going to put in. So from that standpoint, that's obviously very positive there. Your monthly benefit at age 55 would be right at $3,200. Now let's look at age 85. You can see there your death benefit stays the same. So again, that's one of the negative aspects. There's no real potential for growth on that asset from a cash value, from a death benefit standpoint. So you're always going to get that amount back. But you can see the long-term care pool has grown quite a bit. So it's up to over $1.3 million in what you could receive. The max monthly benefit in that scenario is $15,000. Now it's important when you're evaluating what you want to get. There's a statistical aspect to long-term care insurance. Most long-term care claims are 2 to 3 years. So when you see a pool, in this example and the previous example, that was $1 million and right over $1 million here, or over $1 million here. What is the benefit of that? Statistically, you're going to be on claim for 2 to 3 years, so you wouldn't have the ability to get into that full amount actually. Now, I will say there are, Alzheimer's is the best example. That's really has been skewing the numbers. Obviously, it's one of that can be a much longer claim period from that standpoint. So in that scenario, obviously, if you're living 10, 12, 15 years, using all of the long-term care pool becomes much more feasible from that standpoint. But you can see down at the bottom, the premiums and the cash value really are flat, right? So you pay what you pay over 5 years in this example, but your cash value essentially stays at that $100,000. So if you were ever to want to get out, you have the ability to surrender and get your money back. But if you did it 20 years from now, obviously you're losing opportunity of what that asset could have been earning. But you obviously have the insurance the entire time in that scenario. A strategy that is most recent and has really gained popularity is life insurance with a long-term care accelerator, or a long-term care rider is what's become more commonly known. So here you're purchasing a permanent life insurance policy, and then you're adding a rider to that policy. And what you're doing is you're able to access the death benefit. So whatever your death benefit is you're able to access that for long-term care needs. And again, a long-term care need, you've lost the ability to perform 2 of your ADLs, so you just have to qualify for it. Some of the positives, it can be designed to fit many needs. So it can cover your long-term care. There's a death benefit aspect to it, and there's a cash value aspect, and that cash value can grow, as you'll see in an example that we're going to look at here in a little bit. This is a strategy that we often see clients that are debating between self-insuring or are concerned about, well, they don't like all I'm going to get back is either my premium, I'm going to, that's all I've got over a 20-year period of time. This scenario gives you the option for growth from that standpoint. There's tailored premiums, so same thing as with the asset-based. How you pay the premiums can affect what your death benefit is initially, and what your death benefit is initially is what your long-term care pool will be. Again, you have to go through full underwriting so you can receive preferred or preferred best or super preferred ratings depending upon carriers that you're using there from that standpoint. So that is an advantage. The negatives, the guarantees, if they're available, it may be expensive. There's a couple ways you can do it. You can do it with a contract that has a growth component, so the cash value is going to grow. You could do it with a more guaranteed product or guaranteed universal life, where the premiums may be lower, the death benefit will be guaranteed, but the cash value will be very low and eventually will go to zero, but you would still have that guarantee. Other choices may offer long-term care coverage. That's something, as we looked at the other options there from that standpoint, that you would have to take into consideration. When does this scenario work? Let's look at an example. Again, our male 55-year-old, same premiums, $20,000 for 5 years. Again, you can adjust those as you like. The death benefit is always higher, but it's the same as the long-term care pool. So if you look at that, there you've got right at or a little over $350,000 is your death benefit and is your long-term care pool. So if you were to pass away at any time, you're going to get the 350 versus zero from the traditional, or just a little over 100,000 of what you put in, a little over that in the asset-based option. Right out of the gate, one of the advantages is the max monthly benefit is much higher. So it's $14,000 and change there. You don't have to go up with it. The trade-off with that, obviously, is there isn't the inflation protection on the back end. So if you look down here, you can see the premiums, they go up, and then obviously they're leveled off. Your death benefit pool, the gray line across the top, starts higher but stays even for the entire period, but then the cash value grows. So this is for, again, where we see clients using this strategy is where they're considering self-insuring themselves. They're in between, so they want to see some growth to it. If they were to pass away, they want the death benefit to be higher. So they're viewing it as an asset of the estate, right? So these are for clients. When we do planning, we show what are your ending assets at your death, and they may be $5-10 million. This is something that isn't going to be detrimental. So it's not like the traditional care where you get nothing, and it's not like the asset-based where you are just essentially getting back what you put in if you don't ever use it. This gives you a little bit more upside with the trade-off of you're not getting some of that inflation protection. The thing that you want to look at, again, as we talked about previously, is how are you looking at long-term care insurance? Do you want to plan for it that statistically 2 to 3 years your benefit's going to be, you're going to use the benefit, or do you want to have the protection for longer? So that really is going to determine which one is right for you. This isn't a one option is better than the other. It's really about what's right for your specific situation and what you want to get out of using products like this. If this is something that it's of interest to you and that you'd like to discuss further, there'll be an opportunity. We'd be happy to discuss it. We'd be happy to run an analysis specifically for you. Obviously, our analysis is more in depth than what we're able to look at here. We're comparing internal rates of return, doing it against self-insuring, and really looking at all the options for clients to see what is right for them. And I think that's something that's really important. You've got to remember that it's not this option is better than this option. It really, your situation, your risk tolerance, what you want to get out of the strategy is most important to you. And we'd love the opportunity to discuss this with you and to see if this is something that would be appropriate in your current planning. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.